Dividend investing, passive income flowing into your account while you sit back and relax. Sounds like the ultimate hack, right? But what if I told you that this strategy might be holding you back from building real wealth? What if the drip or the dividend snowball methods are fundamentally a flawed investment strategy in today's economy?
I don't believe you. Continue.
Once I did the research and learned the truth, I changed my approach to investing and I've seen a significant difference in my portfolio. And so today I'm breaking down why dividends aren't the magic money tree they're made out to be, the traps most investors fall into, and what you should focus on instead to actually grow your wealth. Oh, and I'll also share the single biggest mindset shift that changed the way I look at investing entirely. Trust me, this one's a game changer.
Prepare to be disappointed.
If you're new to this channel, then hi, I'm Akash, an entrepreneur and a product leader. I've built businesses from scratch, taken some serious risks and learned how to grow wealth even in the darkest of times. And my aim with this channel is to help you escape mediocrity and thrive using the systems and habits that have worked for me. Let's start with why dividends seem so appealing. The idea of passive income is like music to your ears, like getting paid just for holding on to some stocks. I mean, who wouldn't love that, right? I mean, to be honest, I was a victim of this thinking too. Like when I got started with investing, I used to look at some of these ETFs in the US thinking, damn, it'll be great if I can make a guaranteed 4% on my investments.
I was wrong, and really wrong.
And I even put in some money into these ETFs, but it didn't turn out great. I mean, I clearly didn't learn enough from that experience because when I moved to Canada, I noticed that there are numerous companies here that pay out insane dividends, around 5% on an average, and I made the mistake of investing in some of those too. Spoiler alert, actually barely any spoilers here, it didn't turn out great at all. And I'll come to that story in a bit. So yes, dividends can feel rewarding, especially when you're just starting out. They actually make investing feel real because you're getting something tangible back. But here's the catch. Dividends often create this false sense of security, making you think you've hit the jackpot, when in reality, you're just scratching the surface of what your money could actually do.
Potential. What's the potential?
Because dividends aren't free money. They're just your own money being handed back to you. And by that I mean when a company pays you a dividend, their stock price drops by some amount. So they're not actually just giving you free money or additional money, they're just technically moving it around. And this is something most people are unaware of. I mean, go take a look at any stock on the day it pays out a huge dividend and you'll see a small correction in the stock. So while dividends feel rewarding, they don't actually grow your wealth on steroids, they're just a redistribution of the company's profits. And let's be honest, wouldn't you rather the company reinvest that money into growing the business so your stock value actually goes up instead?
Come on, you could be honest.
I mean, this all comes down to the total return of investment at the end of the day, and we'll talk more about that in a bit. For now, let's talk about the numbers and the so-called passive investment promise of dividends. You might have seen numerous stocks stating that they give out a 2 or a 3 or a 4 or a 5 or sometimes even a downright 10% dividend paid out every quarter. The first place most people's minds go to is how this additional money, I mean, we already discussed how it's not additional, can just be a passive income for us. And that's the same thing I thought too. So let me tell you a story to underscore this. As part of my media house, one line of business is to help personal brands and high net worth individuals grow using media and content. And so I had this client back in India who was in her early 50s who quit a super high paying job as an executive at Microsoft, and she wanted to focus on growing her personal brand and content. And when we were crunching the numbers, we were figuring out how we can come up with a sustainable monetary and income model to support her journey. And since I was new to investing, I was excited about how one can grow their money with dividends being the ideal passive income stream and whatnot. And so I suggested to her that she can just rely on her dividends as income or money to build her personal brand, since she had quite a bit of money invested anyway, right? And she looked at me like, what a dumbass. And she said, of course not. I don't have that kind of money coming in from investments to support my lifestyle. And mind you, she'd been investing for more than 30 years pretty heavily in dividend-based companies too, and her investment portfolio is quite big. And that's when it dawned on me. The amount of money you have to invest in a stock for you to be paid money that can actually support you. For instance, let's take a stock like Coca-Cola or J&J, Johnson & Johnson that have been paying dividends for decades now consistently, and they have a dividend yield of about 3%. And so for you to earn $2,000 a month in dividends, which let's face it, is probably not enough for expenses, you'd need about $800,000, $800K invested in just that one stock. All that for just 24 grand a year before taxes.
Taxes? I don't pay no damn taxes.
And of course, if you're thinking about starting small, then at $500 a month in contributions, you'd need nearly, I think, 28 years to reach that amount. Think about that. 28 years of disciplined saving for $2,000 a month. And I can tell you that my client was investing way more than that and she still didn't have enough money coming in. And let's be real, how many of us have like 800K just lying around? I mean, if you're one of them, then why are you even watching these videos?
Hey, Richie Rich. Yeah, I'm talking to you, Richer.
And even if you're reinvesting dividends through the so-called drip method or snowball method, it still takes decades to see significant results. The truth is that building a dividend portfolio is slow, painfully slow. And while you're waiting for those payouts to grow, inflation is silently eating into your returns. And more importantly, the underlying stock may even be losing its value. And that's a good segue into dividend-based stocks and its growth. Trends show that dividend-based stocks, by design, don't grow as much as growth stocks or the broader market index. For instance, the two examples I mentioned earlier, Coca-Cola and Johnson & Johnson, these are the two graphs associated with their growth in the last 5 years. You can see that with J&J, the stock has not grown at all, meaning if you invested $500 into a stock 5 years ago and left it, it would have stayed exactly the same. Actually, you would have lost about 0.5%. Jesus.
Now, why would I want that?
With Coke, you can see that's grown about 13% in the last 5 years. But compare this to the S&P 500, which has grown about 85% over the last 5 years. That's 6 to 7 times the return compared to the Coke stock. This just goes to show that not everything is better with Coke.
You want new Coke, Classic Coke, Cherry Coke, Diet Coke, or caffeine-free Coke?
And if you look at the last 10 years, Coke delivered a total return of 108%, and the S&P 500 a whopping 220%. So it's obvious that the index or growth stocks often outperform dividend stocks in the long run. But why is that? Because by design, growth companies reinvest their profits into innovation, expansion, and scaling rather than paying them out to shareholders. Take Amazon, FICO, and Netflix, 3 stocks I'm very bullish about, by the way. None of them pay any dividends, but their stock prices have skyrocketed because they pour profits back into their businesses. Meanwhile, dividend stocks tend to be from mature companies that aren't growing as fast.
It is about priorities.
If you're overly focused on dividends, you're likely missing out on larger opportunities for growth. And so it's important to look at the bigger picture here and focus on the total returns instead. For this, let's go back to one of the fundamental principles of investing, which a lot of people get wrong. The backbone of any investment isn't the side income, it's the growth of the investment itself. Take real estate as an example. Rental income is great, but that investment is considered a good one if and only if the property appreciates over time. And so identifying the right investment opportunities in real estate comes down to how you can make a massive profit once you sell the property. And dividends work the same way too. They're the bonus and not the main event. Like I mentioned earlier, I invested in some US and Canadian stocks, not solely based on the dividend payout, but it was one of the main reasons for sure. And they didn't fare well at all. TELUS and TD are 2 stocks I invested in right after moving to North America. Well, with TD, I did some fundamental and technical analysis and I was quite bullish on the stock. But I also remember a big reason I decided to invest was because it offered a whopping 5.5% of dividend yield. But for a couple of reasons, the stock just underperformed, and so I kept a trigger to auto sell it after it hit a certain point. And from the image, you can see that I kind of lucked out because right after I made the sale, the stock tanked. I made a decent profit on the sale, about 10 to 15% at least. But if I had held on to the stock, things would look really meek for me right now. But my luck wasn't the same with TELUS though, which I still hold on to till today, with the hopes that the stock will recover a little bit and I can sell it off. But it's just been a bloodbath, as you can see from the image, and since this is a fairly small amount of about $2,000 or $2,500, I've written this amount off and I don't expect to make anything back from the stock anytime soon. But again, one of the big reasons why I bought the stock was definitely a super high dividend yield of about 8.27%. Holy crap, 8.27 is just ridiculous.
It's ridiculous, but I love it.
This is the last time I considered dividend payout as a criteria when picking a stock. And also, to be honest, like I mentioned in some of my previous videos, I'm not too bullish on the Canadian stock market, and this will be the last Canadian investment I'll make because I've moved all of my money to focus on primarily the US stock market as well as get some global exposure as well. If you'd like me to talk more about the reasons why US stocks over Canadian, or just in general why I'm bullish about the US stocks, then let me know down in the comment section below. By the way, my experience underscores another important fundamental challenge with the stock market: the challenge of picking the right freaking stocks. Picking the right dividend stocks is incredibly hard, as you can see. Numbers wise, only less than 1 to 2% of companies consistently beat the S&P 500 while maintaining stable dividends.
That's low, Tuna.
If all of this wasn't reason enough, there's more to add to this unpredictability. Even if you find a good stock, just know that their dividends aren't guaranteed. Companies cut or suspend payouts all the time, especially during downturns. And once a company has set expectations with investors that there'll be dividends paid out on a regular, anytime there's a reduction or a cut or a suspension of a dividend, the stock tanks. For instance, GE, General Electric, a dividend aristocrat, slashed its dividend by over 90% in 2019. So if you're relying on dividends as your primary investment returns, or worse, to pay your bills or cover expenses, then you're taking a massive risk. So if dividends aren't the answer, what should you do instead? Well, after extensive research, here are 3 principles that changed everything for me. 1. Focus on total returns. Look for investments that combine stock price growth and dividends, but more focused on the growth element. The S&P 500 index is a great example. It's diversified and consistently outperforms most dividend stocks. An ETF like 𝗑𝗶𝗶𝗀 also has a dividend yield of around 1.24%, but like I mentioned earlier, that's not the motivation to invest in the stock. 2. Prioritize growth stocks over dividend stocks. Companies like Amazon and Google, and by extension index funds and ETFs, reinvest profits into their businesses, driving higher stock prices. That, in my opinion, is where real wealth is created. 3. Diversify your portfolio. Don't put all your eggs in one basket. Mix in different types of stocks, index funds, and other asset classes to maximize returns while minimizing risk. Since I've only been talking against dividends, it begs the question: is there an instance where dividends do make sense? Well, they can be useful in specific scenarios. For example, dividend aristocrats, basically companies that have increased dividends for 25 plus years, tend to perform well during market downturns. They tend to provide a steady return or income stream and reduce downside risk to a degree. Again, it's just to a degree. This actually makes them great for people in the decumulation phase, like retirees who need consistent income. But if you're in your 20s, 30s, or even your 40s, you're likely in the accumulation phase where you're building wealth. And so focusing on growth stocks or index funds during this stage can give you way better results over time. And finally, I gained clarity only because of a mindset shift. The mindset shift that actually changed everything for me. For me, the biggest change was realizing that wealth isn't built on quick wins. It's about long-term growth and smart decision making. I mean, dividends are nice, but they shouldn't be the cornerstone of your strategy. When I shifted my focus from dividend payouts to total returns, like I mentioned earlier, my portfolio started to grow much faster. It wasn't about chasing quarterly checks, it was about creating long-term value. And if the trends in the market are anything to rely on, then these growth stocks too will eventually start paying out dividends, which I'll treat as a bonus. So should you stop investing in dividends completely? Not necessarily, but if you're relying on them as your main strategy or one of the big strategies or criteria, then you're leaving serious money on the table. Focus on total returns, prioritize growth, and build a portfolio that works smarter, not harder for you. But here's a final kicker. If you're just chasing dividends because you think that's what being rich looks like, where you're constantly paid out some amount every single month, or every quarter for that matter, you're missing the bigger picture. Let's flip this around and ask, how much money do you actually need to earn to be rich? It's not as straightforward as you might think. I go into the details and broke it all down in this video right here. It'll completely change how you look at wealth and also give you an idea of how you compare to others, income and wealth wise. Or maybe you're thinking about diversifying into real estate if dividends is not your thing. Like, buying a home to live in or as an investment. But is that really the smartest move? I've got a playlist here that dives into the hard truths about real estate that most people don't know, including when it might not be the best option. Click here to check it out. It might just save you from an expensive mistake. Thanks for watching, and I'll see you here or here.